Volatility here to stay, but what's BlackRock saying in terms of timing?
Well, they think that this is sort of a shift back to normal. We have gotten used to and perhaps complacent with this idea of really record low volatility for a couple of years. Now we're seeing it really picking up as people get more used to the idea of the Fed backing away from its bond purchases next week, possibly forever, although there are some questions about that. But it's likely that they're going to stop their quantitative easing purchases, and then they're going to prepare to hike benchmark rates next year. So
it really does seem, when you look at the landscape, that investors aren't sure whether or not to dump these riskier assets or to get into them now.
I think that, yes, exactly. Right now, there's been a huge swing in high-yield bond flows and in values. You're seeing some investment firms saying now is a good time to buy. Yields are high. At the same time, people are saying, look, if we are going to be entering a sustained rising rate environment, these bonds have been benefiting the most from the stimulus program. They might stand to lose the most when rates do rise. At the same time, rates are not rising.
Right.
People still expect them to rise, and yet they are not. They are falling. You know, let's be clear. The 10-year has come down from 3% at the end of last year. This sort of defied everyone's expectations. Almost 100% of Wall Street analysts expected yields to rise. They are not. They are falling. So, you know, this is one reason for the volatility as well. People are all on the same side of a trade that's been wrong.
Well, you know, I learned in grade school that for every winner, there's a loser. So who's winning, who's losing, given the current space right now?
Well, the Federal Reserve is winning. They hold a lot of this stuff, right? I mean, they hold a pretty significant proportion of treasuries right now. I think that there are the investors who are plowing into the longer-term treasuries have done incredibly well this year, 20% gains. High-yield bonds, a little less so.
So
you
like
know,
those hedge funds that were in that space?
They've gotten...
They're feeling the pain.
Well, some hedge funds are losing, and I'm guessing that some hedge funds have done pretty well, you know. I mean, the ones that have been sort of global macro-focused hedge funds that have been betting on, you know, swings in commodities prices might have had some more trouble.
Okay, and just really quickly, what's changed now versus a month ago?
You know, I don't know whether it's oil prices falling. I think the global outlook looks weaker. You've got, you know, some predictions that are coming down for what the global growth will look like next year. Ebola is getting people concerned, although I don't know what the realistic economic implications would be for that. So,
okay, Lisa, we'll have to leave it there. Have a great weekend.
Thank you. You too.
See you, Lisa Bromowitz, our debt market specialist.